What's up, investing legends? Today we welcome Ken Gee to the program. Ken's been in the multifamily world for 20 plus years, and he's one of the rare operators who can talk both sides of the game because he came up as a commercial lender, became a CPA, spent years at Deloitte, and then finally made the jump into apartment syndications to improve his quality of life. Well, seems like it's working out just fine for him. In this episode, Ken breaks down how he went from small deals to building a serious operation, why belief is the first hurdle that most investors never clear, and why the real separator isn't motivation, it's discipline. We also get into Ken's preferred market, which is Florida, and the current real estate environment there, why Ken recently shifted into running a fund model, how he thinks about debt risk in the current environment, and the biggest mistake that quietly nukes more deals than bad underwriting. So if you're building a serious real estate portfolio as a solo operator or trying to avoid becoming another 2021 syndicator cautionary tale, this episode has a lot of nuggets for you. So without further ado, let's welcome to the show, Ken Gee.
Welcome to the Investing Secrets Podcast.
Ken, welcome to the vault.
Thanks for having me, man.
Like I was telling you before, I feel like I already know you because I see you all over LinkedIn. I see your people all over LinkedIn. You've got a great team there, man. So
yeah, thank you.
Clearly tell that your operation is dialed in, and I'm sure it wasn't always like that, right? So I'd like to kind of hear what got you what got you here. You're 20 plus years strong in the multifamily sector. So would love to hear kind of like how you got to this point.
Yeah. So, I'll give you the quick story. I grew up in Toledo, Ohio, got my undergrad there. I moved to Cleveland, became a commercial lender for 5 years. While I went to school at night at Case Western Reserve, wanted to be a CPA. Did that, went to work for Deloitte for 7 years on the tax side, did a ton of M&A work, private equity work, all that kind of stuff.
Yeah.
It was there that I came to realize, I don't know how much you know about CPAs, but they work a lot. And my kids were young. Like, this was a long time ago. A lot more hair, a lot younger. And I did my daughter's 3 a.m. feeding every night, right? And it was cool, right? Because I don't know if you have kids, but it's really cool to spend that kind of time with your daughter. Everybody else is asleep. It's just cool. Yeah. Until you realize, wait a minute, tell me it's 3 o'clock in the morning. This is the best you can do. And I started to realize, man, I kind of screwed up, right? I did everything I was supposed to do, went to school, got good grades, got a good job. And now my family's going to grow up without me. And this wasn't cool. So while I was at the bank and while I was at Deloitte, I was always around people who made so much money in real estate, multifamily and everything else. I said, man, I got to figure this out. Bought 3 small deals, sold them 3 years later, made $500,000 and realized, I thought I could do it. I can do it. And so I didn't look back. I quit Deloitte. Deloitte's a great place, but you're not in charge of your life when you're working for a big company like that.
Yeah,
so that's what got me here.
100%. Well, and kudos to you, man, for recognizing that you wanted the change and then doing the things that you needed to do to make the change. I think that a lot of people, especially in our current society, they get stuck in this perpetual hamster wheel of self-pity and victim mentality. And
you're not wrong. You're right. And the people that are able to get themselves, because here's the thing, but what people don't realize is that everyone feels like that at some point. And I'm sure that at some point you were kind of feeling sorry for yourself, right? And you were like, oh man, like woe is me. But then you decided to take ownership of that. And I think that's what separates the winners from the people that end up just living their life on autopilot. Yeah, I would say that it was a little bit that I'd never really much had the victim mentality, but what I did have was this lack of belief, like the thought, see, I grew up, if you knew what I grew up in, and I had an awesome family, awesome parents, but we were not wealthy. I think in my dad's best year, they made $20,000. Like, that was massive. I could have 2 pieces of bologna that year, right, on my sandwich. I'm serious. I know you laugh, but that's how it really was. And so what I had problems with is just believing that somebody would be dumb enough to give me a loan for this big property. And I just couldn't comprehend. I just couldn't see myself being there. That was a battle. And I, fast forward to today, watching other people try to fight through that battle. It's that belief.
it's that belief that, oh, wait a minute, I'm going to be this different person, this guy that owned, hundreds of millions of dollars of real estate. Yeah, that can be you. And they view it as such a mountain that they're just like, I wouldn't climb Mount Everest, right? It's too big. I'm not even going to try. That's what happened to them. And that was the battle. That was my demon early on. I wanted it. I didn't have the victim mentality. I just man, I got to figure this out piece by piece. And I just, sometimes it's good that you don't know too much, right?
Yeah.
You don't know what's coming around the corner. So you just press on, you press on. And, I just used to watch all this, lifestyles of the rich and famous and selling yachts and selling jets and all these shows. I'm like, man, if they can do it, they're not any smarter than me. And you just got to keep talking yourself into it. And eventually you get there. If you take action, you'll get there. That's the thing that people don't understand. Just go do it, man. Just go do it. It's just little baby steps. The next thing you know, you're there.
Yeah. My business coach, many years ago, talked about the idea or the reason why a network and why joining masterminds and coaching programs and things like that are so impactful is because when you don't have that belief, you can borrow someone else's. So, you're at the top of the mountain, you've climbed Everest, and now you get to allow your students to borrow your belief. And that's that borrowed belief that allows you to kind of take action, right? Because you're right. People only take action if they genuinely believe that they're going to get the result, right? And that's why most people don't take action.
Right. Or what I find also happens is they think, John Maxwell is? John Maxwell, leadership guy, wrote a billion books. He has, I saw him live once and he said something that literally has stuck with me to today. People want to do what you do, but they don't want to do what you did. So what they're trying to do is they're trying to find this shortcut. I have people say, isn't there an easier way? I'm like, no. I mean, if you want to hope that you don't lose money, I mean, go wing it, right? Yeah. It's just not easier. So that's the thing. People are always looking for the quick and easy way. Real estate, right? It's a long game. If you do it, you're probably going to be wealthy when you're done. I mean, you just probably will. You just got to be patient. And, I always tell people, let me ask you a question. I want you to give me $100,000. But I don't really know the business really well. I've never done it before, but you'll give me the $100,000 that you worked your ass off to earn, right? And they're like, no, I wouldn't do that. I said, I know.
Exactly.
That's the point, right? So that's the thing that I want people to do, man. Just go do the work. It's a grind, right? You know it. It's a grind. All those little details. I have never found a wealthy person, successful person who said it was easy. If you find one, let me know. I'll talk to them. But I've not been able to find them. They all said it was a grind. They all said it was tough. But you tough through it. You could have a million failures. You just need one success.
Right. I love that. So you buy a couple of multifamily deals, you sell them, you make $500,000.
Yeah, that blew my mind. $500,000 in the bank. What? Are you crazy?
From two slices of bologna to $500,000, we've come a long way, right?
That's ridiculous. It's ridiculous. And you just got to stare at the screen for a while. This is really my bank account. Holy crap.
Yeah. So at what point do you start saying, I'm going to go out and start raising money for these projects as opposed to self-funding? Because that's a big leap for a lot of people. Yeah,
it is. So I'm a CPA by background. I already told you that. Lender by background. I'm a conservative guy, right? And I have some people are really good at BSing. I am terrible at it. Horrible. Yeah. And so the company grew up for the first 10 years in Cleveland, right? Most people, if you said, hey, you want to invest in a deal in Cleveland, they're not going to beat down your door. They're just not. Cleveland's not exciting. So we didn't raise money. I spent 10 years kind of figuring it out, making a lot of mistakes, and we made a lot of money. And then we said, okay, let's go to Florida. Why? Because we can do okay in Cleveland. It's just hard. What if we were actually in a place people really wanted to be in? And so after we got our feet wet in Florida, we realized, you know what? these properties are a hell of a lot more expensive than they were in Cleveland. We're going to run out of money really, really fast.
Yeah.
And so we started that process of raising money so that we could do bigger deals. I mean, in the beginning, it was hard, right? I did it out of necessity, right? I just didn't have $2 million sitting in the bank to spend on one property.
Sure.
Right. So you got to go out and figure this capital raising thing out. I can remember it was Arbors of Garden Grove. That was the first public webinar that I'd ever done. Right? Where people that you don't know are going to show up and ask you questions that you have no idea what they're going to ask you. And it was just really nerve-wracking. What the hard part for me was back then, there were none of these education programs, and none of coaching wasn't a big thing. You just had yourself to go on, right? But again, what did you do? You just did it. You just, like a bull in a china shop, you just went for it anyway. And if you fall on your face, you fall on your face. It is what it is. And so that's why I wanted to do bigger deals. And now we've actually taken that to a new level, because syndicating in a market like Florida is hard, because there's 15, 20 offers every deal. Pick me. I'm the best syndicator. Okay. So I said a number of years ago, I thought, because I understood the private equity model. I said, let's go use the blind pool fund method. Let's go raise the money first and then go find the deal. Well, we started doing that. We're on fund 6 now. Guess what? It works. Because when you have $10, $15 million sitting in a bank, you got a broker's attention. And no longer do you have to worry about syndicators, right? Right. Syndicator, guy that's already got the money in the bank, who are you going to pick as your buyer? Right?
100% the guy that already has the money.
Yeah. And that's kind of how we evolved, right? So, so the thing is, if you haven't done it before, you just got to go do it. Really learn the business. And when we teach people the business, we focus on the why. This is what it is because what happens then is now you're on these investor webinars, and what do? They try to get you. That's what they do. It's fun. It's kind of a game. But if you understand why the business is what it is and why things happen, when your confidence level soars, and it allows you to move forward. Most people stop because they know they don't know. And they don't want to put themselves in that situation. But if you just learn, remember I said, get into the details, really do the work, really learn how to underwrite. Because when you do all of that, you go on a public webinar or, have any conversation with anybody, you're not worried about it because you legitimately know the business. Right? You don't need to go into a second grade math class and study and be worried that you might not know the answer to a question a kid's going to ask you, because you just know it, right? They're probably the scariest of all. But anyway, that's the solution. That's the solution. Really learn the business, because your confidence soars. I find it's people with numbers first. As soon as they really legitimately understand underwriting, not napkin stuff, okay, not guessing. I mean, really understand it, their confidence goes through the roof. Because then what do brokers do? They lean on you. I need another $100,000. I need this. I need that. And you're like, dude, I can't do it. What do you mean? I know I can't do it. How do I know? I know because I know the numbers, you see, and that confidence allows people to go forward. Because you're probably, a guy with real integrity, and you won't lie to people when you're asking them to give you $100,000. You won't. I mean, you just won't. You'll stop yourself because you don't want the consequence.
Yeah. And to unpack that a little bit more, I was just on I just had another podcast, and we were talking about this, this phenomenon over the last 5 years or so, where there were, a lot of syndicators that got caught with the pants down. And it's not that they're bad people. It's honestly that they put the cart before the horse. They ran before they could walk, and they started doing things and raising money for projects that they didn't fully understand how to operate. And money was so easy to get at that point that they just they ran before they walked. And so they asked for the $100,000 before they knew what to do with it, right? And they just assumed that, the market's good, right? And things are good, so we can do it. And then they got caught with their pants down.
Well, think about what happened. So I think about this a lot because I watched it happen in real time. 08, 09, remember, I lived through that, so I know what it means. So coming out of 08, 09, which you're buying in 2011 forward to 2020, 2021, I mean, if you had a heartbeat, you're probably going to make money. I mean, it was really hard to lose money, right? So that's what people see, years and years and years of, man, these guys are making a killing. I got to get in. Then they get FOMO. You know what FOMO is? Mm-hmm. I've classified FOMO as the deadly disease, way worse than COVID. Way worse. It's contagious. Everybody gets it. When you get it, there is no cure. You're screwed. You're just screwed. Yeah. So everybody wants in because everybody's making money, right? Mm-hmm. And then everybody's willing to give you money because the thought of losing money just seemed absurd, right? I mean, any idiot can make money in this market, right? That's what everybody did. So yes, I agree the syndicators got over their skis. Totally agree with you. But I also want to defend them a little bit because there are some just macro things that happened that it's really hard to plan for. Like I remember in 20 or 21, Jerome Powell, we are not raising interest rates, not happening. Inflation is transitory. And then he raised it 550 basis points. Well, right. I don't care how much modeling you do with your deal. You 550 basis, you can't protect against that. I mean, that's just, if you did, you weren't going to buy anything, right? Right. You were competitive. Here's the only way I know to stay out of FOMO. And that is, it's called this discipline thing, right? We have this saying here, don't negotiate your discipline. Our investors, if they ever get mad at us, is because we're too slow to get a deal because I'm disciplined, right? So we know what we need going in. We know the upside has to be there. We have our criteria and we stick to it, right? So the people that are coming out of 21, 22, or 20, and they're okay, it's because they added an enormous amount of new cash flow to their deal because they were disciplined and made sure it was there, and then they executed on their business plan, right? Because what's the only way to protect against a cap rate change from like 4 to 6? New cash flow. I mean, that's your only defense. And so that's why that discipline, the people that are okay did have that discipline. The people that aren't okay didn't have it. They didn't do the work. They didn't really understand how to do rent surveys. They didn't understand that debt can be dangerous, right? They put the short-term bridge stuff in place. Yep. And, well, I don't want to put 7-year debt in place because I'm going to sell in 3 years. Well, if one of those stars gets out of alignment, now your business plan is toast. Right. And now you can't sell when you hoped, you see? So there's a lot of these macro things that are going on that are hurting them, in addition to all the fact that they were inexperienced and whatever. Does that make sense?
100%. And my follow-up question to that, because you touched on this, right, is that, different business plans call for different debt products. I'm curious how you have typically structured your deals to, avoid or mitigate, I should say, the volatility that kind of comes with like the shorter term bridge. Because it sounds like that's probably not something that you use very often, right? So
I don't use it very often. No, if we did, I think we have one bridge loan. It was a fixed rate, and we still have another year extension on it. But I did use a bridge loan on one deal in Tallahassee. I let it sit for 11 months. We knew we were going to move income really fast because the seller didn't pass through water. I mean, it was just, the rents were ridiculously low. We just knew with certainty. So I put the bridge loan in place and took it out 11 months later with Freddie. It was Fannie financing, right? Yeah. So the way to protect yourself is to I like 7-year debt. And people will be like, well, why would you do that? Don't you want to sell it in 2 or 3 years? Now you can't. Yes, you can, because if you sell it, you can use supplementals. Okay. You can put a supplemental loan in place to take care of that gap that otherwise exists. And if the market isn't such that you can sell, you got a long runway. So that's what I try to do, is to protect myself with longer term debt. So the worst thing that happened, remember, I lived through 08, 09, when debts matured at the wrong time, and nobody would refinance anything.
Right.
Not happening. It just wasn't possible. So they lost their buildings despite the fact that they were cash flowing and everything. It didn't matter. So I'm like, man, I don't want that to be me. I want to stretch out my runway as long as I can, right? So that I can fix this thing and allow my income to grow. 7 years is a long time to grow income in a good market. Florida, it just is. So it gives me that level of flexibility. Does that make sense? And if I have to stay in the deal longer. Okay, that's better than the alternative, right? I would agree.
Yeah. Yeah.
So that's how I protect myself. It's that discipline. We want to go in close to even leverage. We want 200 to 300 in upside and be certain about that. Or we're not going to do the deal.
Now, are you buying all over Florida, Ken, or there's like how do you assess, or are you opportunity driven? Are you market specific? Are you driven by the market? A combination of the two? Like how do you track deals?
Yeah. So what's happening right now? You always follow the cycle in this business. We're buying the last two deals we knew were brand new, right out of construction, just out of lease up, and we bought them at almost 6 caps. Now think about that, brand new. Growing Florida market, really good neighborhood, 6 cap, like really? That's ridiculous. Sure. So we're finding, remember, we raised the money in advance, so a really strong buyer. We have builders building ridiculous amounts of stuff, right? True. They need to sell it. They're on variable rate debt. Here we are, a strong buyer. Why wouldn't I want to pick up higher quality assets, right, in good areas at ridiculous cap rates? That's what we're doing right now.
Got it. So what are that's actually really interesting. So these are all Class A buildings that you're buying right now.
Right now, yeah.
Yeah, interesting. Yep. When did you make that switch? Because like were you always buying Class A? My assumption is no.
Yeah. No. The first 10 years was heavy value add, very high leverage. Then we flipped to the syndication model, and we still did value add. Right. So remember, value add, you got to be careful about how you define that. Everybody thinks that means go in and gut the place and renovate. Value add just means somehow add value, either management or improvements or a combination of the both. I mean, we have a deal that we bought 9 years ago for $7.5 million. It's worth 20. Our investment in CapEx was $50,000 9 years ago.
So expense management. Yeah.
Rents are up $700 a month. You do not have to spend a lot of money to raise rents. You just usually don't. So we still look for value add. It usually comes in different ways, right? So you think about a builder. Builders are building. They're leasing up. They're heavy discount, heavy concessions. They lease up and they want to sell because their rate is their variable rate debt. So that's 7, 8, 9%, whatever. It's crazy numbers. And they know that when those leases turn, they got a problem. Because they lured all those people in with 3-4 months of free rent and everything else, right? Well, we'll take on that risk. We'll be happy to turn those units and then stabilize the building. And now we have a brand new asset running at 95% plus occupancy. And that's our value add. See, the value is there because of the way the builder leased the property up. And they all do it. They do it the same way because they can't move forward unless they're full, right? Yeah. Leasing must be right behind their building.
So then what I'm hearing is that, and so from philosophy standpoint, then the lease, their method of leasing up is like a shortcut version, right? They're like, hey, we're gonna gives concessions up the wazoo just to get people in. And from what I'm also hearing, then a lot of those units turn then quickly after the lease period is up. Those tenants usually don't stay. Why is that, do you think? Or is there a reason for that?
Why don't the tenants stay?
Yeah.
Well, because first of all, they're not going to get another 4 months of free rent. That's the only reason they move there. And there are people that literally play that game. I mean, wouldn't you? Or if you could live...
Yeah, I used to do that.
All right, so you used to. All right, So why did you leave? You left because you knew you weren't getting another 4 months, number one. And number two, you know that if you're the builder, you know that property can't survive at those rental rates. It can't. It didn't need to for him.
Right.
He just needed to fill the unit so that he could finish his build and sell to a guy like me. And now we'll re-rent it. So the first time through, we don't get all the way to where we want on our rents because we've got a lot of turnover. That's all right. We're going to fill up. We're always focused on being full because when you're full, everything else in this business falls in line.
Yeah.
Everything. Because now if I want to raise your rent and I got no vacancies, I'm cool. I'll raise your rent.
Yeah. Now I'm assuming, Ken, due to the nature of these investments, one would assume, and I could be wrong, so correct me. One would assume that perhaps the return profiles aren't as lucrative or as crazy as, say, like a heavy value add repositioning. So is that correct or incorrect?
Kind of and kind of no. Let me tell you the life cycle of a real estate guy that sits in my chair.
Yeah.
We start off in heavy value add. Most people that start off in my chair have no money. I know that doesn't make sense to most people because they think they need a lot of money to buy an apartment building, but you don't. So what are you doing? You're doing heavy value adds and you're turning these properties. You're flipping. You're basically a flipper. You're just flipping apartments. And why do you do that? Because you need to make money. You got to build up. You need money, and you're making money.
Yeah.
You got to feed your kids. There's a lot of strains on your life. Now you mature. You don't need to make that money like that anymore, right? Plus it's grueling. I mean, it's a job.
Sure.
So now you flip your mindset to wealth creation mode. Wealth, you want to create wealth, real wealth. Well, look at our Arbors at Garden Grove deal. That's a good example. High quality asset, great area, growing area. We bought it. We didn't have to add much to it. And so we raised $2.2 million to do that deal. So since then, we've not only returned all their money, but we've we given them another $1.8 million. So they put in 2.2. So far, they got back 4. They still have $10 million in equity. They still get quarterly distributions, and there's still a bunch of money in the bank to keep the property updated, right? They took that money out, and what did they do? They go put in another deal.
Sure.
They do that again. And now they have this $20 million asset that's still appreciating. They got nothing in it. This is how you create massive wealth, right? They got nothing in it. They went and did it again, and they did it again. Sometimes with us, sometimes not. Depends on if we have a deal. So you flip to that wealth creation mode. Because here's the reality. The reality of this business is when you've got a high quality asset, people will pay for that. This is their home.
Yeah.
Right? They don't want to. Most people, as they continue to mature in life and, make more money, they don't want to live in a 1-bedroom crappy property. They just don't. Right? So now you give them, have you seen some of these new properties with the amenities? It's nuts. It's a freaking resort.
Luxury.
Right?
Yeah, it's luxurious.
It's ultra luxury. It's crazy. So now you have the ability to charge them more rent because you're no longer dealing with customers that are living paycheck to paycheck. Right? They're looking for quality of life, which gives you the ability to raise rents. So now you have a higher quality asset that you're going to hold longer. The rents continue to improve. You got nothing in it, and you just keep doing it over and over and over. And it creates massive, massive wealth.
Yeah, and I believe
the evolution of somebody in my care.
Well, I believe the fund model actually, supports that business plan, right? Because, and I'm sure that there's funds out there. I know there's funds out there.
Yeah, it supports value add too. You just have to tell your investors what you're going to do and then do it.
Right. But it lends itself nicely. And also like the 7-year debt, right? Like obviously like slapping a 7-year piece on a brand new construction straight out CO. You're not going to need to you're not going to need to refinance, right? Especially if you got a fund. And I'm not sure what are the typical time lengths or what's the usual lifespan of the funds that you're running right now? Like 10 years?
It depends on the asset, right? We do what makes sense. So our Arbors at Garden Grove deal back in 2016, it was supposed to be a 3 to 5 year exit.
Yeah.
That's what we initially thought it would be. But now wait a minute. If you give all your investors their money back and they're still in the deal, they're like, why would you sell this?
Yeah.
Like, why would you sell it? What are you doing? Not one. It's been 9 years. No one has called me and said, would you please sell that thing? Because I'm tired of making money. That's not what they do. Right. They just don't do that. So it's going to depend on the what you're doing depends on the asset. Now, I always tell people the older the asset, the shorter your hold period should be. Why? Because the buildings age. Stuff inside the walls, under the ground. Is not designed to last forever. Trust me, I know, because everything in Cleveland is old. I know what happens inside the walls. So That's a typical value add kind of thing. You don't want to hold that 20 years. You're going to get hammered if you do. But my brand new Levi, in St. Pete, built in 2023, I could easily hold that 10 years and never worry about the building itself. Does that make sense?
Yeah. That makes perfect sense. It makes perfect sense.
And here's the reality. The reality of this is it is so much easier to raise money for a brand new deal than it is to raise money for something that's ugly.
I believe that.
It's just the way it is.
Well, inherently, people, I ask my investors this question all the time. I say, do you want to be sexy or do you want to be rich? And everyone says, well, I'd rather be rich. But the truth is they'd rather be both. They'd rather be sexy and they'd rather be both. And so, it's like, you've got a business plan that supports an asset that is, visually attractive, appealing. People want to live there. It's hard for some investors to invest into something. They're like, I would never mobile. I don't know how these mobile home park guys do. I'm like,
those are cash flow plays. Those are not appreciation plays.
100%. But it's like,
but that's how you make your money in this business is appreciation. Right. It's not the cash flow
in your business.
Well, in any multifamily deal. So here's the thing that investors and people get wrong. I want that cash flow. I want that 8% cash flow. But if you actually did the math, I know because I've done it and we've operated for 10 years this way in the beginning. Don't take that money out. Put that money back into the property so that you can raise rents more. You're going to make a lot more money. Here's why. For every dollar that I raise my NOI, I get about a 20x on that, a 20 multiple.
Right.
20 multiples of 5 cap.
Yeah.
Right? So if you're living in my place and I raise your rent $100, how much did that cost me? A few electrons. I had to email you the lease and DocuSign it, and now I get another $100, right? Think about that, right? In a regular bit, so now that number, that $100 falls. So well, it's actually $1,200 because it's 12 months. Falls to the bottom line. You divide that by 0.05. I'm using round numbers because I'm lazy, right? 1,200 divided by 0.05. That's $24,000 in value. All I did was raise your rent. Now, if you got a regular business and you sell another $100 worth of stuff, right? Now you've got cost of goods sold. You got all these expenses that are going to apply against it. So you'll probably get 20 cents, maybe 30 cents on a dollar that falls right down to EBITDA, which is then typically multiplied by a lower multiple, like 10, 12,
3 or 5. Yeah. It depends on the business.
I mean, a much lower multiple. You see what happens?
Yep.
This is why rich people do real estate because it's just ridiculous, right?
Yeah.
As long as you pick good markets, you know what I mean? You don't pick deteriorating markets and stuff like that. So let's go back to your comment. Early value add, it's about the appreciation. Why did it appreciate? It appreciated because we got more income, right? If you get a property to throw off more income, somebody's probably going to pay you more for it. The big hit is that appreciation. And it happened all the way up the chain, C, B, A. It doesn't matter. The same equation kind of works. And so that's why the real money is in the appreciation. It's not the cash flow. That's why you're right. I could never figure out mobile home parks. Never. Because, I mean, you are, no offense, I don't want to offend anybody that lives in a mobile home park, but most of the people that live there, they're not wealthy.
Right.
I mean, they're every dollar matters to them. Yeah. So you raise the rent a little bit, it matters.
Yep.
Like a lot. You know what I'm saying? When I raise rent on my brand new property, nobody cares. They just don't care.
Right. Yeah. No, and that, I mean, I appreciate the breakdown there because it's hard to conceptualize. Well, it's easy to conceptualize, but it's hard to kind of understand how easy it is to create value in real estate.
But just be careful with the word easy. Just be careful with that word easy because you do have to know what you're doing. You have to do this right. But you're right. I mean, it's not necessarily easy, but boy, I mean, look, when you think about it,
impactful is probably a better word.
There you go. Yeah.
It's so impactful, like tiny hinges swing big doors.
Really?
right?
And you've leveraged it, right? Yeah, you know, if you have a $10 million deal, you probably put $4 million down. And if you raise rent $300, right? At the end of that 5-year period, when you're done, you've probably made $6 million in profit. When you do all the math using a 6 cap, you've got $6 million in profit. You only put in 4. You didn't put in 10. You put in 4.
Right.
See how you're just exploding value.
Yeah.
That's why rich people do this, man. Rich people are not stupid. They're very smart. Do what rich people do because they know they've been taught.
It's you know, the world of alternative investments, and it's crazy that real estate is even kind of like looped into that world, right? But categorically, real estate is considered an alternative investment. Alternative to what? Wall Street, right? Because Wall Street wants you to believe that is that's the only way, you know, to financial freedom. Most of the retirees that I know, and in fact, I don't know a single retiree, and I know a few, without concentrated positions in real estate that are worth millions of dollars. They're all broke. And like
they're
80.
all broke?
No, the ones that don't have concentrated positions in real estate.
Oh yeah.
They all you know, they have their 401k, and it's nothing. It's nothing compared to what most people have who have concentrated positions in real estate. So yeah, it's the only way, really. That or businesses. Like if you own your own business, right? Like that businesses also are huge wealth creator.
The problem with business is you're getting hammered on the tax side. That's the problem with business, right? I mean, there's so many depreciation rules for real estate. It's just really beneficial to be in real estate. It just
100%.
is.
Yeah.
It just is. Yes, you can get rich. So see, and that's what some people get trapped. Well, I can't quadruple my rents in 4 years like I could with my business. Yeah, but there's a lot more risk in business. I mean, it's a completely different risk. Let me back up. Apartments is a business. It's just far less risky because if you were to form a business, whatever product you have, you make, you sell, you whatever, there's a chance it could go away, right? It could become obsolete. Yeah. In my world, I can't figure out how to make it so we don't need a place to live. I can't figure out how to make the product go away. And if it does, we don't care about money. That means we're all dead. Money's irrelevant, you see? And so what I've tried to do throughout my real estate career is just every time I find a risk, I mitigate it. And that's why people that talk to us are like, man, you're like, your buyer pool is so focused. I'm like, well, that's because I'm mitigating all these risks. I'm trying to just improve the chances of success because every time you experience something, you learn a lesson, right? Touch the stove, you're like, damn, that was hot. I won't do that again. Same thing happens in real estate.
Right. Yeah, man. No, it's this conversation has been awesome, man. I mean, we touched on a whole bunch of things, and I definitely agree with with everything that you said. It's been an insightful conversation. Ken, if the people back at home want to reach out to you, they want to learn more about how to invest with you, et cetera, how can they get a hold?
Yeah, just go to our 2 ways. One, go to our website, KRIPartners.com. So KRIPartners.com, and it'll kind of send you one of 2 ways. Either do you want to do your own deals? We can help you figure that out. You want to invest passively? We can help you figure that out. Or if you really just want to talk to somebody about just like, what do I do first? What do I do next? Help me figure this thing out. Our people are here to do that. 216-290-1707. And I think you've talked to some of our people. They're here to help you figure it out. What is going to work for you? And if we got nothing for you, that's cool. What really matters is we're trying to help people make, create wealth through real estate. It has completely changed my life. And if I could help you do that too, then that's cool. I feel good about that.
I can personally vouch for Ken's team. They are dialed in, is what I would say. He's got a really dialed in system. Can tell that you run a tight ship there, man. So kudos to you.
Yeah, thank you.
And congratulations on all your success. Ken, but you're not done yet, man. I'm not letting you out of the vault just yet. Before you leave, you got to leave the audience with one final investing secret. Take it away, my friend.
Yeah. So I've kind of already touched on this. Please do not get FOMO. And the only way to not get FOMO is to get disciplined and just stick to your discipline, right? Yeah. You've got to do that. If you don't do that, you're going to get FOMO. If you get FOMO, you're toast. I'm just telling you, that's what happens.
And by discipline, so contextualize that for us a little bit, Ken. Yeah. So when you say that, because you said it before, like, do you mean like stay focused or have a certain set of principles, or like what do you mean by like stay disciplined and don't like contextualize?
Yeah. So let me give you an example. We're looking for mostly A, maybe B assets in growing neighborhoods, good neighborhoods that are crime free, that we can pick up at close to even leverage, and it has 200 to 300 in upside. That's what I'm looking for. Why? Because over almost 30 years, I know that's what works. I know the system works. So now let's get undisciplined. There's this beautiful place. It's in, there's two cities. They're 200 miles apart. This thing is right in the middle. These two are growing together over the next 30 years. There's 400 units in that market. I want to buy this 100-suiter. And I don't know who I'm going to rent to, but, it's going to grow together.
Yes.
You see, I just busted my discipline.
Yeah.
There's a million ways to break your discipline, right?
Yeah.
Or don't do the homework and buy something because you think it's in a decent neighborhood. Oh, and of course rents are going to go up. There's no visible evidence right now that you have upside, but of course rents are going to go up. Now you've speculated, right? You don't have any real proof that you just busted your discipline. And every time you bust that discipline, it's because you're getting FOMO. Because what happens, especially if you raise your money in advance like we do, you got investors pissed. Dude, when are you going to get a deal? Dude, do you want me to put you in a good deal, or do you want me to put you in a deal? I'm just telling you, those are the discussions that we have. And when you're getting that kind of pressure, it's real easy to start stretching your discipline, to start getting FOMO. And then because the pressure becomes hard, right? And so we tell our investors all the time, look, we're going to be slow. It's okay if you don't want to invest with us. I would rather have you not invest with me than for me to bust my discipline and have you angry with me because I put you in a deal that I shouldn't have done. Because guess whose money is sitting right next to yours?
Yours.
Mine. Yeah. And I don't want to lose my money. I don't want to lose yours either. So that's an example. People do this all the time. I tell you, stay in the fairway, especially your first deal. They're not only in the rough, they're off on 2 holes over. They slice the hell out of the drive. They couldn't hit it back to the right fairway if they wanted to because they found some convoluted situation somewhere. Yeah. Just totally bust their discipline. Yeah. They do it all the time, and I don't know why, but they do.
Yeah. That's great context there, man. And I totally agree. And I think that's great advice for people back at home, especially the ones who are just getting started, right? Because there's so many shiny objects. So many shiny objects.
Hard. It's hard because I got a deal and he got a deal and he got a deal. Man, I got to get a deal. That's what happened. It's hard. Yeah. I'm going to give it to you. It's really hard. Yep. Just don't do it. Yeah. If you want to get FOMO, call our team. We'll talk you out of it. I promise you. Because they know we talk about this every day.
I love it, man. Multifamily therapy with Ken.
There you go. There you go.
I like good stuff, brother. Ken, thanks for stopping by, man. And look forward to seeing you and all your continued success.
Yeah. Hey, thanks so much for having me. And hopefully somebody was able to get something out of here. Hopefully I can help somebody.
Absolutely.